So yes, this came in from Steven via email, and he says, I'm curious what your guys' opinion is of Trigon Metals. It's a copper mine that closed a long time ago due to mismanagement. It has now reopened under new management, and they've transitioned recently from the low margin open pit mine to focusing more on underground mining. If they achieve what they say, it could easily be a 30 bagger, it would seem, and much of the risk has already been removed, it seems. The stock seems dirt cheap. What's your take? So Trigon Metals, TM on the TSX Venture, currently trading at a price of about 85 cents with a market cap of 38 million. And again, like Steven says, they are a copper miner, which holds an 80% interest in its flagship project, the Combat Mine property, which consists of 5 mining licenses and 2 prospecting licenses located in northern Namibia. Now, something to quickly note is just that the company did do a 1-for-5 share consolidation in May of 2024, bringing the company's outstanding share balance down from about 218 million shares to about 44 million today. Now, the Combat Mine originally opened in 1961, and between 1962 to 2007, it produced about 12.5 million tons of ore, but closed due to low copper prices and underground flooding in 2007, or at least that's what I could find. However, with renewed interest, Trigon has placed a current expected life of mine of approximately 15 plus years on the Combat property with a new strategy. And looking at the mining strategy, so Trigon's strategy with the mine has been restarting the open pit in May of 2023, which is in production, with the second phase being the reopening of the ASIS West underground mine, which has been ramping up since February of 2024, which starts with the ASIS West shaft complex and thereafter moving on to the ASIS Far West shaft into 2025. Now, the company also plans to expand the mill's throughput from about 30,000 tons per month to about 60,000 tons per month in order to have the capacity ready to increase throughput for additional material from the underground operations. But I will note in the company's MD&A, they noted that they anticipate raising further capital to fund its development of ASIS West and the proposed mill expansion. They also note in the MD&A that they expect to continue to incur losses in the near term as it ramps up its mining operations, and that there can be no assurance that the company will generate any profitability. So keep that in mind. Now, if we look at the company's copper production guidance into 2025, they are projecting to do about 12.5 million pounds of copper production with a C1 cash cost of about $3.15 to $2.80 per pound. And looking forward to 2026, they're looking at scaling copper production upward to over 30 million pounds and then up to 69 million pounds in 2027. Now, one thing to understand about C1 cash cost is that while they are guiding it to be from about $3.15 to $2.80 per pound in 2025, which in theory gives them some leeway with the volatile price of copper, as copper trades in the $4 range, it is important to understand that the C1 cost metric does not include costs like capital costs for buying, maintaining, or upgrading equipment and buildings, corporate overhead costs, or any other costs not directly related to production. So whether the company will generate or begin to generate net income is still a little unclear to me. And I would really like to see a few quarters in 2025 to see what kind of progress they're actually making on the bottom line. Now, moving to the most recent financial results for fiscal year 2024, keep in mind the results are in US dollars. So revenues were 9.6 million for the year, but the company actually posted a gross loss of 1.1 million, which again is before any other operating expenses. And on the bottom line, the company posted a net loss from continuing operations of about 1.5 million for the year, but the company had a 10.7 million dollar accretion adjustment to its Sprott royalty following the release of its updated feasibility study. So if we remove that artificial gain, the net loss for the year would be, closer to the $10 million mark. Cash flow from operations was a loss of 3.3 million. And quickly just going over the balance sheet, as at March 31st of 2024, Trigon had cash of 1.4 million with no debt, but they did have leases of 5.1 million, which is primarily for equipment financing. And I'll also note that the company has negative working capital of about 8.8 million, which again is somewhat of a concern, especially as the business needs capital to expand. So to conclude on Trigon, I think the growth story here is intriguing. Management has a plan to increase copper production significantly over the next few years, but I don't think that it's a free lunch to 30 bagger land by any means. And personally, I think that risk remains very high, and I don't really think that it's de-risked, as Steven says. Now, in theory, if the price of copper remains elevated and management can execute on their guidance and produce bottom line profitability and cash flow, there's certainly a speculative case to be made for the stock. But again, the company is relying on a volatile commodity, and there remains significant execution and operational risk from management on whether they will be able to achieve their targets without running into any hurdles, which obviously, are quite prevalent in the mining sector. Plus, as it stands right now, I do not have a clear indication that the business will be able to generate profitability, and it will likely need to raise additional capital to expand its underground mining and its mill from 30,000 tons per day to 60,000 tons per day. So, all in all, this is not the profile of a business which we would classify as a 30 bagger or even a 10 bagger at that. This question is quite timely as we do have a new upcoming webinar series at the end of August and into early September, focusing on stocks with the profile of a 10 bagger potential. But again, the story sounds good on paper and in Trigon's presentation. But I would like to see a few more quarters to see how they're actually pacing or tracking toward their guidance and whether they can achieve that bottom line profitability. So as it stands, it's not a stock which we would recommend at this point, and not a business that I think will provide 10x returns with low risk.
Yeah, I think you need some operational cash flow before it's de-risked
Yeah.
towards any type of positive return. So, like a 30 or a 10 or a 100 or whatever times multiple, 20% higher, it has to be powered by actual underlying cash flow. Now, you could project that out based on their guidance, but again, it's based on a volatile underlying commodity too. They could produce at the cash cost they're producing now. Copper goes well below $3, which it has,
Yeah.
and you suddenly you don't have a profitable business, even if production is ramped up and costs are kept in control. So that we often looking at metals companies or commodity based businesses as more trades than in long term investments, and we don't trade a lot, so most of our investments are outside of this segment. There are some ways to play these segments. We had a company that is a driller. It doesn't necessarily drill for copper, but they came out with results today. The stock was up 15% because the results were tremendously strong. And it is a way to de-risk yourself from getting some exposure to the say the gold sector, because they're drilling for 20, 15, 100 companies, and it spreads your risk out across those companies. And again, that there is ways to play commodity based businesses that are less risky than the one or a commodity based business strictly that just drills for an underlying commodity, or sorry, it produces as well as drills. And this company really is just in the initial stages, so certainly not
Yeah.
de-risk at this point.
Yeah, exactly. And like that's the thing. I mean, we'd love to see a little bit of indication of profitability rather than just going off of, targets and guidance. It would be great if, they actually had a cash rich balance sheet, which is obviously something that we love when it comes to a commodity based business. Not only would they maybe be able to actually fund internally the new mill and the expansion of the underground, but it would make it so they don't have to, go to the market potentially and issue shares. I think the last time that they issued shares was in July of 2023. I'm pretty sure from my research there, my quick research. But I would anticipate that they will likely have to go back to the market
And this
and raise.
company's already shown it will issue, and has
Consolidate.
consolidated
Yeah.
again. So that is the pattern with most of these companies, and it's very difficult to uh, you know make a long-term gain when you're being consolidated.
Yeah.
Its dilution is significant. So there is, even with a company that had in this sector cash in the bank, a profitable existing mine, there is no de-risking. They are high risk, these
Totally.
type of businesses. So yeah, we would not say, and I get what is being trying to be said by the de-risking, but there is high risk is what we have to say, just generally in these business, just operating even a well-run great project that looks great. And I don't think this project is there yet.
As well, just furthering on top of that, Namibia, it's a geopolitically risky area. It's not by any means the riskiest in Africa, but it's still a risky region of the world.
Totally.
So you got to add that on top of the usual commodity stuff which we've been talking about.
Yeah, for sure. Adding some significant geopolitical risk for sure.